morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, January 18th. We got a few economic news to go over today, so we'll jump right into it. And so let's start off with the weekly jobless claims that we get every week. Last week we had 261,000 people apply for unemployment. A forecast for this week's numbers was 250,000. It came in at 220,000. Now, this will be important to see if this is a trend. We were kind of getting down to like 220, 230 range for a while there, but again, then we kind of went upwards. Now, sometimes we kind of get those numbers in January, primarily because we get a lot of people that will go get these uh, temporary jobs for the season, for the holidays, and then they go back on unemployment line come January. But we also had some weather issues that may have presented some people going in there as well. So let's see if this is a trend that we're going to get back to this range, or so we'll have a strong jobs number for the month of January, or potentially maybe it's just due to the weather. That's why people didn't go, why it dropped so rapidly. So that's 41,000, which is a pretty big uh, drop there as well. So again, we'll see the jobs numbers here in a couple of weeks for the month of January. So it'll be interesting to see what comes up. Also, we got housing starts for the month of December. So in November, we had a 1.299 million set, and the forecast is supposed to dip a little bit to 1.28, and it dipped a bit further down to 1.192. So not as well as they'd like it to be, but still decent number. On the other hand, we had building permits for the month of December. We had 1.303, and it dipped to 1.302. So almost basically about the same. Not really much difference in terms of building permits. So that's kind of the future. So we're getting housing starts now, but we're also looking at, and a lot of that has to do with single families. But building permits, are still pretty high and showing for future business there. Last but not least, we got the Philly Fed, which we had, which is manufacturing in the Philadelphia region. So if you remember earlier in the week, we had the New York, which dipped, and as we can see, it dipped again in the Philadelphia region. So we had a 27.9, and it dipped down to 122.2. This is a 5-month low here. So again, we'll have to kind of watch and see if it's just kind of a trend where manufacturers going to pull back, or if it's just kind of a blip in the month of January. That January just happens to be a not good month for manufacturing. So let's kind of jump ahead here to the headline news. Stock market is mixed. It kind of came in, started out the day off unchanged, and then pretty much all three indexes were down, and then at one point, NASDAQ kind of rose up a little bit. It's taking it's possible, some of it from Q4 earnings reports, and then also a possible threat of partial government shutdown that the government is trying to get something. Both parties are working together and trying to prevent a shutdown, which needs to be done by midnight of Friday evening. Otherwise, we'll go into what they call partial government shutdown. So they're trying to work towards that. And of course, one of the sticking points is on immigration. They may come out with another one like they usually do, where they kick the can down the street, where they'll get something for maybe about a month like they've done the last 2 months. But again, we'll have to kind of watch and see if it leads to a shutdown, or if they can come up with a long-term solution, or if it's just going to be another thing where they kick the can down. Now, typically we've been able to avoid these things and at least get something moving forward a little bit, but we'll just kind of have to see what happens moving forward here. So let's kind of go ahead here. Some of the stuff I want to say here, I'm going to touch on here going ahead. We got the bond market, which is down. We're down currently about 8 basis points, but we were down further. So when investors came out with pricing, it came in much lower. So most investors will come in with worse pricing, especially when we had a trend yesterday where it dropped quite a bit. So we're down currently about 8 to 9 basis points from where we left off yesterday. But when investors or lenders came out with their pricing, it was lower at that time, so they're going to err to the more conservative side, and you'll see a little bit higher rates today as a result. Also, so one of the reasons also I want to touch on the mortgage-backed securities is that people are kind of wondering about rates. They're looking at short-term rates, the Fed raising rates. That's typically will actually help out long-term rates, primarily because when the Fed raises short-term rates, it helps stave off any inflation, which is the enemy for bonds. But one of the reasons why you're still seeing that going up is because if you recall back in October, we talked about the great unwind, which the Fed is reducing their balance sheets and they're not buying as much bonds. That is one of the reasons why you're seeing that there's less demand for the bonds, which is why you're seeing the bond prices go down, which is driving interest rates up. And you'll see this continue each quarter. They're reducing it further and further, and they'll be fully going into effect probably by October this year. So they started off with about, I think it was like $4 billion. Now they're at about $8 billion. It'll be 12, 20. So each quarter will be like each purchase will be about 20 billion less than what they were purchasing before. So so rates were artificially low to begin with because they were doing the quantitative easing, purchasing extra bonds, and we also had appetite from foreign investors. But some of the foreign investors, which we'll touch on here in the 10-year Treasury, as you see, we're kind of reaching this point here at the 2.61 range. And right here, this 2.635, this is going to be an important level to keep treasuries or yields low. On a global level, yields have been rising, which is one of the things that is could pose a threat to stocks as well. Because what happens is once we reach this level, the stocks being in a risky level as they are as assets, this might become a little bit of a safer haven for them, and with a higher yield, they might be more satisfied with this type of investment. So this could be also competing with stocks as well as mortgage-backed securities. So if it passes this level, we got another another 30 basis points higher that could even compete with it more. Now, one of the things that's keeping foreign appetite away from buying more of our yields is primarily because the dollar also has weakened. As the dollar has weakened, so if they're buying into our currency, even though we're probably about 2% higher than most yields out there, they lose that on the currency exchange. So since the dollar has weakened against most of the major currencies out there, they lose about 10% of that on the currency exchange or currency swaps out there. So that's why you're not seeing as much foreign investments jumping into this. But domestically, it's still a pretty good bet for them as we're not having to deal with the currency exchange. So these are some things to keep an eye on going forward here, jumping forward here. But to kind of conclude, the rates have climbed up today as a result. Some things we got to watch out for, as we had pointed out. But if you guys want, we're going to conclude it today. But if you guys want to get more information, just come over to Twitter. I will be posting throughout the day, and at Mike Bjork's my handle. And see you there. Otherwise, I look forward to see you guys tomorrow. Have a great day. Thanks for watching. Bye-bye.